Hi and very good evening. So today me and my friends are gonna talk about ABN Fuja Berhad and Elcom Sedan Berhad main activity, their financial ratio, and some suggestions to fix their current financial performance. Firstly, I will talk about ABN Fuja Berhad main activity. ABN Fuja is an investment holding company while its subsidiary Merge Batteries Manufacturing Sarawak Sdn Bhd. ABM is principally engaged in the manufacturing of a comprehensive range of automotive batteries and batteries for storage and electrical application. Fuja intended principal activity is manufacturing and batteries and accumulators. On July 2023, Fuja has commenced its operation and began manufacturing batteries. As a key player in the batteries manufacturing and marketing business, ABN Fuja and its group of companies, the group operates from its manufacturing and sale facility located in Kuching, Sarawak and Kota Kinabalu, Sabah. Over the years, Fuja Group has invested in high-tech and automated plants and machinery to equip us with capabilities to design, manufacture, and supplies a wide range of products to supply to our local and overseas customers.
For the ratio calculation of APM Fujiya Berhad, first we got liquidity ratio, which consists of current ratio and quick ratio. A current ratio of 0.95 means that a company has 0.95 cents in current assets for every 1 ringgit in current liabilities. This indicates that the company may not have enough short-term assets to cover its short-term obligation if the oil came due at once. Next is a quick assets. The total is 0.47, suggests that the company has only 47 cents in quick assets for every 1 ringgit in current liabilities. This is generally considered low, as it suggests the company might struggle to meet its short-term obligation without relying on selling inventory or securing additional funding. Next is activity ratio. First is a total asset turnover ratio, and the total is 0.31, indicates that the company generates 31 cents in revenue for every 1 ringgit of total asset it owns. This is a measure of how effectively the company is using its asset to generate sales. Second is an account receivable turnover ratio. The total is 1.70, which means that the company collects receivable 1.7 times per year. This ratio measures how efficiently a company collects the money owed by customer, its account receivable, and how quickly it turns those receivables into cash. Other than that, we also got profitability ratios. First, we got profit margin on sales. The total is negative 0.12. A negative profit margin of 0.12 or negative 12% means the company is operating at a loss, with a 12% loss for every 1 ringgit of sales revenue. This indicates that for every ringgit the company earns in revenue, it lost 12 cents after covering all its expense, including cost of goods sold, operating expense, interest, and tax. Second, we got return on common shareholder, and the total is negative 0.1. A negative return on common shareholder equity of negative 0.1 or negative 10% means that the company is generating a loss for its shareholder. Specifically, for every 1 ringgit of equity invested by the common shareholders, the company is losing 10 cents. Last but not least, we got leverage ratios. First is a debt to asset ratio. The total is 0.69, means that 69% of the company's total assets are financed through debt, and the remaining 31% is financed through equity or other source. This ratio provides insights into the company leverage and financial risk. Second, we got debt to equity ratio, and the total is 1.47, means that for every 1 ringgit of equity, the company has 1 ringgit 47 in debt. This ratio provides an indication of the financial leverage of the company and reflects how much debt the company is using to finance its operation relative to its equity.
Hello everyone, my name is Du Ziyao and my metric number is 702564. Next, I will introduce description and suggestions parts. On the description parts, Elcom Group Berhad is Malaysia's largest manufacturing of rolled aluminium products, and a leading supplier is the Asian Pacific region, with a strong global presence. The company offers tailored aluminium solutions for various industries, including engineering, construction, and manufacturing. Known for its state-of-the-art technology and high-quality products, Elcom is a pioneer in the aluminium industry, excelling in the production of feedstock using heating and cooling systems. with advanced research and development capabilities. Alcom plays a key role in the shape future aluminium design trends.
Hello and very good evening to Doctor. So today I'm going to present about Alcom Sdn Bhd ratio company. So firstly we talk about their liquidity ratio such as current ratio and quick ratio. As you can see, the current ratio give us 1.88, which means the company has 1.88 billion in current asset for every 1 billion of current liabilities that they have. This shows us strong short-term liquidity. Other than that, their quick ratio give 1.202. With that amount, the company has sufficient liquid asset, excluding inventories, to cover their current liabilities. This indicates good liquidity without relying on their inventory sales. So, secondly, about leverage ratio. So first, we go through their debt to asset ratio. After the calculation, this company bring their figure 0.48, which means Alcom Sdn Bhd use 0.48 480,000 ringgit of debt for every 1 billion of their equity. This moderate leverage level a balanced approach to financing, not overly reliant on debt. However, their debt to equity ratio 58.72%, which is indicates a high reliance on debt relative to the company total capital structure. And then thirdly, we talk about their activity ratio, such as total asset turnover and account receivable turnover. So the total asset turnover, we get 1.36. So the company generates 1.36 billion in revenue for every 1 billion ringgit invest in total asset. This suggests efficient utilization of asset to generate sale. For the account receivable turnover, this company show us 11.75%, which means the company effectively manage its inventory, turning it over approximately 11.75 times during that period. So last but not least, we talk about profitability ratio. It's divided by two sections. And then first, we get profit margin on sale. And then second one, return on common shareholder equity. So for the first one, this company give negative profit, negative 0.01. That show us that the company incur a loss for every 1 billion ringgit of revenue. For the return on common shareholder, show us a zero amount. This clearly show us that this company not generating some profit from its asset. I think that's all from me. I'm gonna pass this slide to my friend.
For liquidity ratios, Alcom company has strong liquidity with a current ratio of 1.88 and quick ratio of 1.20, showing it can easily meet short-term obligations. For ABN Fujiya company has a weak liquidity with a current ratio of 0.65 and quick ratios of 0.47, indicating reliance on inventory and insufficient liquid assets. For conclusion, Alcom is more financially stable than ABN Fujiya. For activity ratios, for Alcom company has total asset turnover at 1.26, highly efficient in generating revenue from assets. Inventory turnover is 11.75, which has excellent inventory management. For ABN Fujiya company, it has total asset turnover at 0.31, low asset utilization efficiency. For ABN Fujiya, account receivable turnover is 1.70, moderate efficiency in collecting receivables. For conclusion, Alcom outperforms ABN Fujiya in both asset utilization and operational efficiency. Now, we're comparing the financial performance of two companies, Alcom and ABN Fujiya. For net profit margin, Alcom company has negative 1%, indicating a small loss per unit of sales. ABN Fujiya company has negative 12%, reflecting a larger loss per unit of sales. For return on assets and return on equity, Alcom company has 0%, showing no returns but close to break-even. ABN Fujiya has negative 10%, signaling significant losses on equity investments. For conclusion, while both companies are currently unprofitable, Alcom is in a less severe financial position compared to ABN Fujiya, as evidenced by its narrow losses and proximity to break even. Next, the financial leverage of Elcom and ABM Fujiya using key metrics. Debt to asset ratios. Elcom company has 0.48, indicating moderate financial risk, with 48% of assets financed by debt. ABM Fujiya company has 0.69, reflecting high financial risk with 69% of assets financed by debt. Debt to equity ratios. Elcom company has 0.48, showing a balanced financing approach. ABM Fujiya has 1.47, indicating heavy reliance on debt. For conclusion, Elcom demonstrates a more conservative approach to leverage and carry lower financial risk compared to ABM Fujiya, which is highly leveraged and depended heavily on debt for financing.
There are 4 suggestions that can ABM Fujiya Berhad take to improve their current performance. Firstly is improve cash flow management, which is ABM Fujiya Berhad need to implement strict credit terms for customers and improve follow-up processes for overdue payment. Secondly is increase sales effort, which is higher sales directly improve this ratio. ABM Fujiya Berhad can enhance marketing campaign to expand into new markets or doing big scale of promotion to attract large scale of customers. Thirdly is re-evaluate pricing strategies, which is to ensure product or services are priced to cover costs and generate profit. ABM Fujiya Berhad had to conduct market research to find competitive but profitability pricing strategy. Last but not least is reduce reliance on debt, which means ABM Fujiya Berhad need to focus on paying down high interest debt and emit new borrowing to reduce reliance on debt.
Suggestions part. First, adjust the capital structure. The debt of Elcom Group Berhad is a bit high, and the debt to equity ratio is 58.72%. You can try to raise funds more through equity financing. On the one hand, this can reduce the financial risk, and on the other hand, it can also make investors think the company is more stable and attract more funds. Second, increase the utilization rate of assets. Look at the current asset situation of the company. Which resources are not being used? For example, idle equipment or properties can be considered for renting out, or by improving the production process. The benefits of these assets can be maximized. Third one, enhance the profitability. Invest more resources in those products or business with high profit and reduce those with low profit or even losses. In this way, the overall income will naturally increase. Fourth one, control cost. It can start from 2 aspects. One is to optimize the supply chain and strive to reduce the procurement costs. The second one is digital management. For example, using the intelligent tools to improve office efficiency can save a lot of labor and operating costs. My speech is over here. Thank you all.